And you really do need cushion to operate these deals, particularly in the B and C space where you're dealing with assets 40, 50 years old. Things are going to go wrong. I mean, like, just think about a car. Like, we have cars that are 10 years old and things break all the time. Imagine if we're 40, 50 years old and getting abused and used by residents that are in and out of there. So
you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithkatani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny, and I'm joined today by Ryan Christopher Nunes. Ryan was a leading commodity derivatives salesperson at Wall Street banks for 13 years. He transitioned to multifamily in 2019 as a general partner in $64 million of assets and passive investor in 3,194 units across Texas, Florida, Arizona, Georgia, and Ohio. He's the founder of Life-Changing Capital, a Houston, Texas-based commercial real estate private equity firm, and takes an institutional, transparent, and hands-on approach to multifamily. Ryan, welcome to the show.
Jonny, thanks for having me on. I really appreciate it.
Absolutely. Very excited to chat today. Like I mentioned offline, I also, was a licensed broker, not nearly to the extent of you, but I also take the sort of institutional Wall Street approach to commercial real estate. So very excited to get your touch on that. But take us to the beginning here. Obviously worked on Wall Street for a long time. Kind of take us back there and what led you to leave and come to commercial real estate.
Yeah, for sure. So I did my undergrad at Georgetown in finance and my MBA at NYU. And when I was at NYU, I was rubbing shoulders with a lot of folks that were on Wall Street, had an opportunity to join commodity derivatives sales for a Wall Street firm. And so did that for a number of years through a series of promotions, was running teams for the Americas, very successful career, generated north of $200 million. And so what we did, how I explain it to commercial real estate folks, is we locked in oil and gas prices as if real estate folks were fixing their interest rates for loans. So we did that for airlines, cruise lines, oil and gas producers, power plants, and so on and so forth. So really enjoyed that career. I did see a number of things transitioning and changing in that market, just going more electronified, similar to the kind of the revolution of tech for trading. It just seemed that I was looking at my career and saying, what am I going to do with the next half? And particularly as I had kids that are now 10 and 12, was thinking, how can I set them up for success instead of hoping they get into great colleges and so forth, but what can I give them? What can I apprentice them with? And so that really birthed Life-Changing Capital. And so in my transition, that I was looking for something that would have those elements, transferable skills, something I could apprentice my children with, and something that would have longevity and sustainability to it. And when I came across multifamily, I was like, this is what I've been looking for many years. Had an opportunity to exit from the commodities world and really pivoted full time into commercial real estate. And this was 2019. And so needed to get involved as a general partner in a number of deals for tax purposes. And so was able to partner with two very experienced partners, and we bought two deals together. And then as I was, wanted to just get my hands really dirty with the asset management of those properties and learn everything I could about the business. And so felt pretty comfortable and just realizing that, yes, what I was looking for was transferable skills to real estate, and was able to actualize some of those things, and said, now I'm looking for someone that has been on Wall Street to then partner with. And we started looking at some 300 deals together, and we picked up 3 in the past 18 to 20 months. And so we've been working on those, managing those deals. We have one that will hopefully close by the time this podcast is aired, so that'll be pretty exciting for us. And so it's been an exciting run. We feel like we've always, for me, I've always looked back and said, what did I used to do on the commodity side? How did I approach this problem? Or, well, how did I solve this? And so, it's really thinking first commodities in that risk management angle, and then applying it to real estate.
That's awesome. I love that. I love that transition because you had an opportunity to exit, probably had an opportunity to stay as well, I'm sure, and keep going. But I can imagine that it's very, time consuming and taxing. And I love that of course, commercial real estate is as well, but it also awards definitely a lot more freedom, as well along with it. So kind of give some examples, from previous commodities trading to commercial real estate that you were able to kind of tie together and bring to this industry.
Yeah, so a number of things, and I can walk through some specific examples, but for us, on the commodity side, it was always like someone was going to be more asked to take down a trade than somebody else. And so seeing that, you could get a much better price, a much better outcome for your client if you knew how to lay off that risk properly. And when we closed on our first deal, we had one lender that we've been working with, and we really tried extremely hard to give him the business. And he showed us a quote that was, effectively, from a proceeds perspective, was like, the max I could do was 70% LTV, and your interest rate is going to be, 425, and in 2 years interest only. And then we said, this just doesn't work. Like, we need something better. Other people are quoting something better. And, we fortunately built other relationships, and, just kind of leveraging our, our backgrounds, and saying, like, just because you're talking with one person, sometimes you have to make sure you have, alternative path. And so we fortunately just, for a pretty small deal, we were able to get an interest rate, instead of 425, we got 371. Instead of 3 years IO, instead of 2 years IO, we got 3. And then instead of proceeds being 70%, we got close to 80%, which, all in all saved us around $240,000, which is pretty material, for an equity raise that was $2 million. So, that's the type of thing that we try to show. A small example, but just, through our, no one taught us real estate, but it was through our background, saying, hey, we know that someone else is better placed to do this debt. Let's find out, but we're not going to just take no for an answer. This is the best I can do. We really try to figure out an alternative way. And then secondly, I think just from an investor relations standpoint, and we've always tried and done everything possible to go above and beyond in explaining, one, the deal, the risks of a transaction. And so if you looked at our webinars, it is very clearly, here's the risk reward, here's the fees that we're making, just very transparent. And that was really just from the discipline of, anytime we talked with a client, we had to make sure they understood the risk, the rewards, and everything was, it wasn't slanted, if you will, but it was just, here's the opportunity. I'm going to be completely transparent. I'll take any questions that you have, and I only want you to invest if you feel comfortable and confident in your decision. So, that going above and beyond approach, from a commodities, being in the commodity space, commodities by definition are something that is commoditized. So there's no difference between your barrel of oil or my barrel of oil or any other person's barrel of oil. And so you have to work really hard to differentiate yourself. And so we really try to go above and beyond and taking a very institutional, transparent, and hands-on approach to the asset class. We want our investors to feel that their monthly reporting is timely, it's transparent. They don't need to dig through a bunch of stuff to get the answers. They know where income is, they know where NOI is, they know where expenses are, they know kind of the highlights of the deal. And we just really try, even if there's an issue, we just disclose it, and say, here's our solution, here's our thought process. Because, working on Wall Street, people, can absorb a mistake if they feel like you used it was in your, you exercise good judgment. Not everything is going to go right on a trading desk. You're going to lose money some days, but did you exercise good judgment? Did you try to recover? And so kind of that approach is how we've, in a number of different ways, we've approached multifamily.
I love that. Wow. That was very well articulated, because especially in multifamily now, right? There's a lot of players in the market. So being able to differentiate yourself, even down, the tiniest little percentage can mean so much, right? And so being able to even have that little tiny difference, can be the difference between, one investor basically getting an investor on board and not really. And so I love that approach a lot. So you mentioned that you didn't really know anything about commercial real estate. Did you just jump in head first? Did you jump into like a mentorship group, or, just kind of learn on your own?
Yeah, I jumped into a mentorship group because of the lack of time that I had. So I got into the space around April, May 2019 and had until December for tax purposes because of the tax year. So joined a mentorship group and then really learned that this was going to be a learning by doing process. We looked at some 300 deals. We started picking apart what are the things that matter to us, what are the things that don't matter, what makes a deal perform, what makes it not perform, and really just trying to build a database of relative value. From a commodity standpoint, we'd always think in terms of, hey, this is a good trade because look where that traded, or look at this value. And we think about the same thing on multifamily. It's like, what are the key components of something that we like, what's something that we don't like, and how can we ensure and de-risk that transaction before we buy it? So those are some of the things that we look at.
I love that incredible approach. Talk about, obviously, you mentioned in commodities, right? If you, lose on a trade, did you do your best, try to recover, use good judgment? In real estate, it's the same thing, like you mentioned, right? Being transparent. Talk about maybe some bumps along the road, or mistakes you made that, you were able to relay to your investors and keep going.
Yeah, for sure. There definitely has been, bumps. It's when you think about just fundamentally, you have a, let's say 100-unit property, you have 100 different families living at your property. They all have, no one's perfect. And so you compound that, you multiply it. So it's a challenging operationally. It can be very challenging. One recent example, which is, when we bought our San Antonio asset in October 2020, the eviction moratorium was still in place, and there was no rent relief. And so when we bought it, people are like, I don't have to pay rent because you can't throw me out because you have an agency loan, and under the CARES Act, you can't evict me. And so we kind of played along with a number of these residents. We're like, hey, pretty please pay rent. Okay, you're not going to pay. Well, can you apply for rent relief now? As a few months went on. And so, fast forward a year to October 2021, when you actually could start evicting people. So we had people living there, some people living there a year that just chose to free ride. And so we had applied a number of those people to rent relief. Rent relief started getting tapped out. And one person had such a high balance that it was like, okay, we can't let you leave because we're going to take a huge write-off. And we just need to pray that rent relief comes in for you. And so we kept checking on this person, our property manager. We first incentivized the property manager with a bonus to, if we got this rent payment for that resident, she was going to get a $300 bonus, which, is material. And all of a sudden, the resident wasn't responding. Let's say her name is Alma, and she wasn't responding. And all of a sudden it was like, why are you no longer responding? You're coming into the office, we're making calls to the rental agencies. And we found out that she got denied. And so we're like, oh my gosh, we had applied for $10,000 of rent relief for one resident. So it's a material amount.
Absolutely.
And especially when you're trying to sell a deal and they look at T3. And so those things compound, right? So like $1 worth $20 when you're trying to sell. And so 10,000 is worth, whatever that is, 200,000. And so we decided to say, hey, you cannot let her leave. Like, we need to figure it out. We need to call the rental agency or rental assistance and understand the situation. And apparently they, she reiterated her story to the rental assistance people, and they said, oh, we denied you because you needed one signature on this form. So this was 2 weeks ago when we found out we were denied after a year of asking for rental assistance. And then that week, we found out, we pivoted, we said, you need to bring her in. So they did that. They called and they found out, okay, you just need that signature. They got the signature. And then a week later, we got a $10,000 check in the mail this week. So, just huge bump in the road, but then again, trying to pivot. What else can we do? Like, all hands on deck to figure it out. And then it became a really, joyous moment for our team. And we thank them profusely. Like, we really appreciate the work. And right away, I sent an email to her boss saying she did awesome. Please pay her that bonus. So, we just try to create win-win situations. Candidly, if there's something that's really important to me, a Wall Street approach is like, well, we just firmly believe that you're going to do whatever you're incentivized to do. So rightly or wrongly. So if you want to create a good incentive, like, okay, this rental assistance check is really important to us. So I'm going to pay you $300 if you get this person, just clearly mapped out, very transparent goals. And we've had that at all of our properties for different things that we've wanted to do. And we've created fun competitions to say, hey, we're going to buy, lunch for the team with the highest collections or the highest occupancy over the next 30 days. So just ways to get more integrated, but also to keep it fun, keep them, engaged, to perform well.
Awesome. I love that. Wow. That's a wild story. I hadn't heard that, that large of an amount before with that rent moratorium and all of that. So that's awesome that came through, because
Yeah.
so you were trying to sell it is what was the issue?
Yeah, no,
Was
it's
the
been under
biggest-
contract, and you have to manage these things very carefully. And, you have to be careful when write-offs come. And, we had been telling them that she's applying for rent relief. So it's like, yeah, we know we're carrying a big balance there, but she's applying, and the rent assistance folks are asking for documents, meaning they're engaged, but then all of a sudden it came back no. And we're like, now it's a credibility issue of like, we told them we're doing everything possible and it got denied. And it was like, we got to try and solve this. So,
And that gets denied because of you guys or because of
no, it was the resident didn't fill out a form properly. I mean, simple things, but this is a governmental thing, and it's very bureaucratic. It takes them months to review documents, and so so we just had the team call back with the resident. Like, and the other thing is, our team couldn't just call back ourselves. Like, we need the resident to be there. So you have to get them in the office, called together, to really, dissect the situation and solve it.
Geez, that's wild. That's that was a nice probably intro into the industry. You're like, okay, here we go. This is
Yeah,
these are the challenges.
and I'd say the biggest challenge is fundamentally is that, I have pictures of my kids here where I'm looking, and, I say that no one cares about your kids, your money more than you do. And now it's like, no one cares about your kids, your money, and your multifamily properties more than you do. So, you try to, do everything possible. Like, I go to our property every Friday and I spend the whole day there, to show them like, hey, I'm going to work with you. I'm going to pick up trash. I'm going to talk with residents. I'm really going to understand what's going on so I can help you. And, really work alongside you so you understand like how much I care, and we're going to empower you and help. But it's a challenge. I mean, to get people as passionate and fired up about something as you are, because that like you're going to live and die by how
Yep.
these deals perform, right? I mean, it's a highly levered space. I mean, putting 75-80% of debt on a property. I mean, it's great when things are going up, and it's horrible when things are going down. So you got to be, super careful, manage that risk tightly, but also, make sure that you're bringing people along for that ride. So they're like, I want to see you guys succeed. And I'm like, I want to see you succeed. So let's do this. And so, yeah.
Absolutely. Yeah. It's so important because, like you said, nobody cares as much as you do about it. And so, trying to get them on board with the mission can be challenging, right? Because, their priorities are different. right? They've
Absolutely.
got families and different things going on. So it can be challenging, um, but I love that. And that's great. And I'm sure you were obviously very transparent with your investors as well, which I know goes a long way with them. So as we're kind of shifting now economically, obviously you're very data driven. What are you seeing, and what is it, if anything, is changing in your guys' approach as you move forward?
I don't know if feel free to edit this out, but I feel like I'm a little bit in left field, saying this, but I've been bearish on multifamily for a little while. And, I think it's just gotten to a point where you have so many people crowding the space and, deals. It's like we talk about we're going to underwrite realistically. And it's like, yeah, you should. But if you want to win a deal, you're underwriting realistically in an unrealistic environment where people are just willing to pay crazy amounts for things that don't make sense. The benefit of being invested in 20 deals passively is I see a lot. And I can see, that a lot of deals are not performing anywhere close to pro forma, needless to say, even cash flowing. So when I see, and I'm in a number of these deals, one just sold last week where they had grown NOI 10% over 2 years. You have another buyer coming in, and they were using agency debt, which is the most, generous debt, if you will, and the safest debt. And someone's buying it with bridge. They're saying, I'm going to grow NOI 40% in 2 years, and I'm paying 50% more. So all of their expenses, property taxes, insurance, everything is going up against them, payroll. And yet this deal didn't cash flow. They only grew NOI 10%, but this person's saying, I'm going to buy it and I'm going to grow it 40%. And it's just like, how can you not be a seller in that environment? Frankly, we're trying to sell everything we own. It's just,
Yeah.
we've felt that way for a while. We haven't bought anything in the past year because the pricing just went crazy. And you really do need cushion to operate these deals, particularly in the B and C space where you're dealing with assets 40, 50 years old. Things are going to go wrong. I mean, like, just think about a car. Like, we have cars that are 10 years old and things break all the time. Imagine if we're 40, 50 years old and
Right.
getting abused and used by residents that are in and out of there. So, what I see happening is people wanting to leave their job to find something more meaningful, and they find meaning in having their own business, running their own business in multifamily, which is great, but not really understanding how much work it is. And I think everyone glorifies the acquisition,
Mhm.
but they low light the day-to-day operations, and it is so operationally intensive. Again, I'm at our property every single Friday, the whole day. I'll be in shorts and the t-shirt, just sweating it out. And it's just what it takes to make these deals succeed. And, I think just given what we're seeing in the marketplace, my view was that occupancy, people talked about absorption, and it was like, well, yeah, I mean, there's a ton of absorption because people had moved in with their parents during COVID. And then they got, infighting happened. They moved out. They went into apartments because they realized, hey, if I just get in, I don't have to pay rent. They can't evict me. So absorption went through the roof. Occupancy went through the roof. But when you really shook it out and said, well, what are collections?
Yeah.
That unit was occupied that I was telling you about by this lady who hadn't paid rent. So our occupancy looked high. But we were carrying this huge delinquency. And so fortunately we got a rent relief check, and, we had gotten many rent relief checks, and that artificially held up collections, right? Because it was rental assistance. All of a sudden rental assistance goes away, delinquency, flies through the roof, and you have to kick people out because you can evict them. Finally, you're like, I've been waiting to evict you. You haven't paid it all. You're gone. And, now you're in a situation where, you're going to have to cut rents, occupancy is falling. That's kind of what I see happening. And then when you look at property taxes and, and insurance, I mean, we've had insurance seen it double. Like, how do you manage that? Property taxes that are going up, where the assessor just said, everything in the headlines is real estate's through the roof. So it's like, okay, well, we're going to assess you at 120% of purchase price because we can, and then you'll fight it, and we'll get north of 100% of purchase price. So, a lot of these things are non-controllable expenses, and then add in the interest rates. that, we're looking at when we bought one of our deals, interest rates were 0.0002%, 2 basis points, so 0.02%. And those are forecasted to be, 3% next year. So, that's a huge move, right? Fortunately, we have an interest rate cap in place, but that's how can you buy a deal, let's say at a 3 or 4 cap when your debt is going to cost you 6 or 7%? Like it doesn't make sense. So, I personally see a repricing in the market of 10 to 15%. And when you think about that, people are like, oh, equities. I'm not a fan of throwing equities under the bus. I think each asset class has its merits. And, the pros and cons of equities is that it's liquid. The con of real estate is completely illiquid multifamily. And, when you look at something, and if you said, I have to mark to market. So here's a Wall Street term, mark to market, which everything we did in commodities was like, I don't care if you're going to hold that thing for 10 years. I want the value of it today, right now. How much would it be worth if you had to sell it right now? And so when you think about that mindset, like equities, Amazon stock, if you bought it, you could sell it, it's traded every nanosecond of the day. So there's a price. But multifamily, there isn't. Like, it's illiquid. And, if when people say like, oh, I'm making so much money with multifamily, it's like, well, tell me when you get out of it, how much you truly made, right? So yes, I've done well. Other people have done well, but there's also like people that don't want to tell their stories of how they lost money, or how their deals did go sideways. So, on the multifamily side, if you think pricing went down 10 to 15% because of the interest rate move, just in the past 2 months, I would say. And if you look at a deal that had, let's say a $10 million deal, so there's $2.5 million of equity in it because you're 75% leverage. And if it goes down 10 to 15%, let's just say 15%, simple math, the value of the deal went down $1.5 million. Well, the 2.5 million equity is now only worth $1 million. So, you've lost more than 50%. And people talk about, oh, liquid equities, they went down 15, 20%. I'm like, multifamily just went down 50% on the equity side. So, if you had to sell it today, right? Fortunately, if you have good loans and you have, a 10-year loan, you can, ride out these bumps, which is, again, a risk management thing that, people need to be mindful of. But, I feel like it's almost like beating up your sister. It's just like, just don't do that. There's merits to each asset class. And, I personally have made a lot of money just buying index funds on the equity side. And it's been a great long-term strategy. It's been a lot less work than it has been on multifamily. So again, the merits, the pros and cons. But, I think what you're going to see happen over the next year to 2 years is a lot of people that took bridge loans, that, bit off more than they could chew. They're going to get sideways.
I've been saying this.
It's and people don't like to talk about it. I'm just being realistic. I feel like I've seen the script so many times. Another Wall Street thing is on the commodity side. When we dealt with things that were liquid, you have to be really careful because it was opaque. It was like, okay, we're pricing this option on some random gas location that doesn't trade. And it's like someone's value is going to be very different than another person's. And that's what I'm saying here is that someone came out and bid high and it was like, wow, like, yeah, we'll sell it to them. And, there could be that person that is, buying and all of a sudden they stop buying and it's like, oh, the buying market was a lot thinner than we thought. And, I just got a text on the way over here, a deal that I'm passively invested in. The person who's buying it, their loan proceeds got cut and the equity's been hard to raise. So it's happening. It's real. And, it's one of those things where there's going to be a shakeout. A lot of the people that got into the space without business background, I really firmly believe you're running a business, you need to have some business acumen, to do these deals. I feel like there's going to be, a period, compound that with bridge loan, compound that with insurance and, property taxes where people are like, I need to get out and, I may lose some money. But, I think that's just, people lose money all the time in equities. Like I lost money today in equities, right? The markets were down. But, how long can you hold on is really the question.
That's the difference, right? In equities, especially, and I used to tell my clients is, listen, you're down, but it's not a realized loss. You haven't realized a loss, right? You
Absolutely.
can ride this out. Unfortunately, in commercial real estate multifamily specifically, is if you're down, you're talking about a bank, an institution potentially coming and seizing your asset, right? So
Yes.
it's very, unless, like you said, you have something in place where you can ride it out, there will be no riding. The
Yes.
horse will be pulled from under you, and that will be
Yeah,
it.
you're absolutely right. You're absolutely right. And that's what's scary. I mean, high leverage cuts both ways. Like, it's amazing when markets are running, and it is horrible when markets are turning. And I think we're in a period, it's like, it to me, I've just seen things where people like look, just human nature. And again, same thing in commodities, where something like cold weather today, which you can't predict weather more than a few days, right? And in our markets, natural gas, oil, like it would be such a weather dependent market. So the market would get so skittish, like it's cold today, so the whole forward curve out 5 years is shifting because of weather. It's like, that made no sense to me. And I think what's happening in multifamily equivalently, because you asked parallels from Wall Street to here. So
Right. Yeah, I
is
love it.
you're seeing, okay, the occupancy I talked about, the rent growth. And it's like, yeah, you had rent growth because our occupancy was artificially inflated. And the next person that came in, there was less units available. But as you evict people, there's more excess capacity, and people are underwriting like rent growth is going to continue compounding. And that's just not going to happen. It's just not. Particularly even if there's a 50 or 25 or 30, whatever percentage chance of recession, if you haircut your rent growth in the out years by that much, it's like, it's a totally different, total return than what you
Absolutely.
just underwrote. So, I just think people need to be prudent. When I got into this space, I was really attracted. I was like, I want 8 to 12%, let's say 8 to 10% cash on cash. Like, I felt, given the illiquidity of the asset, given the vintage of a 1960, 70 B and C asset, given the illiquidity, I've already said that, I'm sorry. I just felt like that liquidity is a big thing for commodity traders.
Absolutely.
So, given those things, you need to have an 8 to 10% cash on cash. Otherwise, why not invest in something else? So I'm very relative value driven. So as treasuries come up, you're 3%, like when that was 1.2%, like, it's like, man, I'll invest in multifamily. But now it's like, there's other, oil and gas stocks that are paying very attractive dividends, that these guys are, like, I've never seen commodities so bullish given what's happening in Ukraine. So it's like, you have to think about, don't just blindly follow, multifamily because the next guy's doing it. Like, think about, does this make sense to me? And is this the right thing? So, but I think it's a great asset class. It's just, just think about relative value, because the world changes each day. Like, all these risky assets are repriced, and where does multifamily sit within that?
Absolutely. And it's time for repricing, right? Like, equities is repriced, nearly daily, right? But you've just seen up and up and up, and it has to give somewhere. And like you said, with everybody involved. Now, I do think there's a lot of capital available. So I'm not sure you'll see, a year long, just absolute drop, assets dropping left and right. I do think there's enough capital poised to prop the market back up, but you're going to see it, right? And those that are set up to jump in there are going to jump in and take on these distressed assets. Hopefully that's, ideally what happens. Are you guys eyeing any other asset classes in real estate asset classes because of this, or?
We're looking at development, which is a longer term project. But I frankly, if I I need to make more time, spend more time, but I think self storage is something that is interesting, because as we look at multifamily, is operationally challenging. It's painful, and something where you have to deal with just goods in a closet, seems like a lot easier to manage, getting
I'm
good
all about
staff.
self storage. I've been
Yeah.
preaching self-storage for a while.
Nice. We should
Yeah, so
probably
I'm
talk.
right
Yeah.
there with you, man. That just low
Yeah.
maintenance, you're not dealing with someone who hasn't paid rent for a whole year.
Absolutely.
There's no
Absolutely.
rent moratoriums. You can kick them out,
Absolutely. Absolutely.
Um,
And
yeah,
so, it's the kind of what I set out to do was impact people. And we've definitely done that. We've had resident events. Very frequently at our properties, we're hosting a summer camp for kids. We're hosting a pool party tomorrow at one of our properties. We've really tried to serve the residents. We hope that they appreciate that. And we see a reflection of that in our Google ratings. All our properties are 4-star, which, it's tough for 1960s, 70s properties to have 4-star ratings, but we really try to go above and beyond, but it comes at a cost. It's very time consuming. And it's I think the whole market got distorted with not to talk politics, but whenever you dump that much money and you tell people you don't need to go to work and we're going to pay you to stay at home, like, you're going to have massive distortions. And that's unfortunately what we're dealing with.
couldn't agree more. And I love what you said earlier. Everybody celebrates the acquisition. Don't get me wrong, you should celebrate that, especially in this market, right? Acquisitions are tough, but the real work is ahead. And on the other end of that is another human being, right? And I love that you guys are so focused on taking care of those human beings, because yes, it is a business. It needs to be run correctly. And, we want to have good returns for our investors and for ourselves, but, we also need to take care of the people, on the other side of that. So you mentioned you're a passive investor. I just want to touch on this real quick. In about
Sure.
25 deals, were you passively in multifamily before you left commodities? Was it something you?
No.
Oh
So
wow,
on
okay.
Wall
So you're brand
Street,
new to
like,
that too.
yeah, they, on working on Wall Street, you have to give them access to like all your accounts, because they're very sensitive about insider trading. Headline risk is a big risk for Wall Street firms. I mean, they want to, again, judgment is so important. So if someone, does something that just stupid, it's like, you're fired, no questions asked, like, and so and I've seen people fired because they ordered lunch, like, dinner, you're only supposed to order if you're staying after 9. They ordered something at 8:40 and then they left. And then they say, oh, like, I was there past 9, and they'll check your key card, and it's like, no, you keyed out at 8:45, like, you're fired, you lied. I mean, so just any angle of like judgment lapse is game over. So that you give them your portfolio of equities. And so I was like, you know what, you guys are paying me so well, and I really love this, in terms of the job that I was doing, that like, I didn't have the time to monkey around with other things. And equities were working really well. It's like, just buy index funds and enjoy life. And that worked really well. And so when I left Wall Street and it was like, the world is open to you, then I was like, okay, well, let's look at multifamily investments. And a big push for me was the tax benefits. And I invested, for every $100,000 invested, I got back a $73,000 loss, paper loss, depreciation loss, on my tax return. So that was very motivating, very compelling. And so that was a big factor of why I also did a number of those passive investments. Also, to learn from the second one was to learn from how other sponsors were doing things, how they were communicating with investors, learn about different markets, and if those were markets we were interested in.
I love that. That's awesome. And yeah, I mean, that is one I see, right? You never, well, of course the bonus depreciation is nice, but sounds like you may have some that are, you mentioned, not cash flowing.
Yeah, that's correct. And that's just a brutal truth of the deals. But when I look at the deals that I'm involved in, the deals that I'm passive in, it's like you see a huge trend towards strong performance on the ones I'm involved with. And that's just given me confidence that it's like, you came into the space, you were trusting more senior sponsors, people with longer tenure in multifamily, because you felt inadequate. Like, you were like, I don't know enough to know what I don't know. But it's like, just trust your business judgment and look at how your deals are performing. Like, invest in yourself, because you're going to be there every Friday, and those other guys might not ever go to the properties. The performance looks that way. And so I love when people that I'm passively invested, like, we're selling, I'm like, amazing, sell now. So the good thing is a number of those deals are selling, especially ones that have been struggling. But again, it was a diversification play. Wall Street tip is diversify as much as you can. People on Wall Street are always paranoid about losing money. And we've seen things go pear-shaped all at once. Like if when you began 2022, everyone's like bullish everything, stocks are up, crypto, everything was higher. And then it's like all of a sudden the correlation goes to 1 and everything is sold off. So, I've seen that before. It happened in 2008. I worked on Wall Street then and remember that vividly, walking by, Lehman Brothers and Bear Stearns and like, wow, this is really happening. Very prestigious firms, things can happen. That black swan event happens more often than we would think.
I know, it's true. I love that perspective. Awesome. Well, as we wind down here, I've got 5 questions I ask all of my guests. It's the final 5, so we'll jump to those. First question: best advice you've gotten from a mentor?
Is, for being in sales, do business with people that like you and don't worry about the people that don't. Like if you're always going to be worried about, oh, this person doesn't like me, what do they think about me? It's like, don't worry about that. Focus on the people that you like and do as much business with them as possible. And, when I was at church on Sunday, it's a very wise line. I should look it up on my phone, but it was like, you would worry a lot less about what people think if you knew how seldom they think about you. So meaning like, we're always worried, what will someone think about me? And it's like, you know what? Truthfully, they don't really think about you that much anyway. So don't worry about it. So
I literally
anyway, yeah.
just had this exact pitch. So on every Friday, I put out a solo episode, and I just said, because I just hit my first like big failure where a deal went south. I lost money. This was like a development deal, but I realized I was like, I was stood on the sidelines for so long because I was so afraid of what people thought if I failed. And then I failed and I realized nobody cared. Yeah. Right. And not that nobody cares. The ones who care about you are there for you, but you realize that not that many people are looking at you anyway. And I think social media distorts that for a lot of people. They think because they have followers and people are watching them on social media, they actually like care about that person, but they really don't. They have their own lives to worry about. And so you shouldn't be afraid to fail or mess up because what someone might think, because that person really isn't thinking about it anyway. So
that's well, thanks for being revealing about that.
Yeah. I mean, listen, they don't always work out. You win some, you lose some, unfortunately.
Absolutely.
What is it about your career that makes you feel like you're fulfilling your why?
I'm going to be taking my kids to a property. They're done with school tomorrow. And, just being able for them to tangibly see and help at the property and seeing the impact and explain things to them in a very tangible way. That's a nice thing about real estate is you can put your hand on it and you can see the business happening in front of you. Like this resident comes in, we treat them well. They want to stay there longer. They pay the rent, they bring their friends, and you have a very healthy business. So, that's something that, is part of my why, is like impacting lives, apprenticing my kids.
I love that. Yeah. You started with that. And I love hearing you just sticking to that. That's awesome. Favorite non-real estate or investment related book?
The book that my favorite book is a book called Love Does that, when I was, I had a promotion and I was going to be leading a lot of people. And I read this book in the most timely time. And it really taught me about how to be selfless as a leader and how to really cheer your teammates on and to really think of things. And I wrote about this on LinkedIn, to be a player coach. So, I love basketball. So, and, going out there and, not only just, cheering them on, but helping them, being on the floor and moving the ball, getting to the open person, setting the screen, whatever it is. So, that book spoke to me in that way. It's called Love Does by Bob Goff. And fortunately, I've got to meet him a few times and I still keep that book by my table because it was so inspiring to me.
I love that. I'm going to add it to the list. If you could have any superpower, what would it be?
I think like to connect with people more, where it's like, okay, we're not seeing eye to eye. Like, how do we just connect? And, with my kids, or sometimes it's like they're having an off day. How do we just, get it back together? That would be awesome.
I love that. That's awesome. Last one. What's the best way for people to get a hold of you and learn more if they want?
Absolutely. You can reach me at lifechangingcapital.com. So there I have some of the articles that I mentioned where we've written about how we apply Wall Street principles to multifamily. My email there is there, and you can set up a call. So lifechangingcapital.com. And one thing that I have for your listeners that may be helpful is 25 questions every passive investor should ask. And as people are thinking about investing in multifamily deals, this is kind of from my background, coming from Wall Street and not knowing where to start and asking and dissecting and analyzing deals. These are the things that I started asking and looking at. So that's available. 25 questions every passive investor should ask on lifechangingcapital.com.
Awesome. We will link that in the show notes. Ryan, this has been truly incredible. I really, really appreciate this.
No, thanks for having me on. I really appreciate it, Jonny.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.